It's great to have you here on the Clark Howard Show. You know, our mission is to serve you with advice and information that empowers you so you make better financial decisions in your life. And, you know, I am obsessed with living on less than what I make, saving for the future. And I recently saw some stats on the average 401k balance by generational group. And there's a real troublesome spot that I want to address. Also, if you or someone you know does contract work, does a side hustle, whatever, I've got some key information for you about taxes that you cannot ignore. So there's an issue I want to address that was in a report from Fidelity Investments, which has one of the largest 401k programs, if not the largest, in the United States. Fidelity has long been a big-time player in 401ks and has just such great data on what's going on with 401ks. And there is something that is clear as could be in their data, and that is that Gen X, which are people that were born 1965 to 1980, are having a harder time saving for their future than other age brackets. Particularly, interestingly enough, people born as millennials or Gen Zers, they're in a different situation. I have one millennial, I have two Gen Zer kids, and they came of age in an era where they never had any belief that there was going to be anything like Social Security for them by the time they hit retirement age. And that pessimism that they were on their own has led people in my kids' generations, the two that they're in, to be much better savers for retirement from a younger age than was true of the baby boomers and the Gen Xers. So the baby boomers, so many of them had pensions or have pensions because they grew up in a different era. Many of them worked for one company for a really long time or an entire working lifetime and graduated from there, from work, with a pension. Today, almost nobody has a pension. And there's this difference in expectations of people, especially who were teenagers during the Great Recession, when they saw either one or both parents lose jobs. Many suffered the trauma of the family home being foreclosed on. I remember my oldest daughter was in college during the Great Recession, and a lot of her friends had to drop out of college because one or both parents had lost their jobs. And they were just gone. And let me tell you, that made an impression on Rebecca, seeing what happened to other kids. So there is this expectation among millennials and Gen Zs that they've got me, myself, and I to rely upon. And the language of 401k, Roth IRA, is stuff that they know about even as teenagers, and if not as teenagers, early 20s. Gen Xers, on the other hand, grew up in a period that was kind of neither here nor there. And so there was never any talk about, well, you gotta start saving young, and you gotta save in this, and you gotta save in that. And so they were late learners. And think about the ages, mid-40s to nearly 60 years old. And so they're at a stage in Gen X that there's not enough money saved, not enough money invested for retirement. And so the challenge for Gen Xers is to boost the amount of money you're saving, to take it up several notches from where it is, if you're in a position to afford it. The other thing is Gen Xers, more than prior generations, are going to have to work to later ages than they may have intended. And this isn't true of every Gen Xer. I'm standing next to a Gen Xer who is a maniac saving money.
Thanks to you and your advice over the years.
No. Before we even knew each other, you were
I listened to you on the radio. I'm telling you, you inspired me at a very early age. Okay, and I do want to make a note for my fellow Gen Xers. If you're 50 or more, don't forget about the catch-up contributions.
Ketchup is not like mustard. It's not something you put on a hamburger. Ketchup is a provision that allows you to put additional money each year into a Roth IRA or
401k.
But it's huge additional money in a 401k.
Right.
It's a little additional contribution to a Roth, but big for a 401k, either Roth version or traditional. So, you save when you save, you start when you start, and do what you can to increase what you're doing. And it is not, people shame themselves and they feel guilt. I didn't do this. I should have done that. We are part of the era we grow up in, and it was never talked about to people in Gen X. Never discussed. As far as how much additional, it's $7,500 a year. In the 401k, it's $1,000 a year. $1,000, right?
In the Roth, I believe so.
Roth IRA. So, catch-up is your friend. Additional years of work may be your friend.
Side gigs.
Side gigs could be your friend. We're going to talk more about a negative consequence of side gigs a little later.
I was just with my friend who's an elementary school teacher. She does that, and then she has a photography business because she loves photography. She takes senior portraits of students.
I can't imagine a better elementary school teacher.
She's amazing.
Than your
Julie,
friend.
love her. And now
she is such a sweet person.
And in the summer, she has a retail job as well at a fancy store where she gets a huge discount, and she's just like, I love it. She's hustling.
Can you imagine me with a side hustle in a fancy clothing store? I'd say, that really is expensive. It's a really nice outfit. I just don't know you should buy it. It's so expensive.
Yeah, seriously. You would not do well.
I would not do well.
All right, we'll go to questions here. JJ in Florida wrote in with this one. On a recent Clark Stink segment, you said not to use Zelle because if a criminal hacks into your bank account, then they have the ability to move money out of your account. That left me wondering, if they hacked into my account, could they enroll my account in Zelle without my knowledge and then move money without my consent? Should I avoid using a bank that even offers Zelle?
That's a great question. Okay, so JJ, if somebody successfully hacks in and takes over your account, they're not going to use Zelle to take the money out. They're going to do a wire transfer where they can move all the money all at once, sending it somewhere likely offshore. So Zelle is something that would be eating up the money around the edges. If somebody does a successful takeover of your account, they're going to get all that money out in one fell swoop, or maybe two wire transfers out in hours. Zelle would not be efficient enough if there's a decent amount of money in the account. Now, the good news, the scenario you painted, somebody hacks in, takes over your account. Under federal law, the bank is the one that has to eat the money stolen from your account, not you, unless it is a family member who is the one who impersonates you, and steals the money, then you have to actually, as distasteful as this is, you have to go file a police report against your own relative in order to establish with the financial institution that you are, in fact, an innocent victim of it and not a willing participant, because the burden of proof is higher when it's a family member, which is a very common circumstance, unfortunately, when accounts get hacked.
Peyton in Georgia says, if I pay off my credit card a few days before my due date and then use it again, how is the interest rate applied to my account if it's even applied? Does the rule also vary from credit card company to credit card company?
So, Peyton, this is almost universal that credit card interest rate is calculated daily. So if you were to pay a balance early, whatever amount you pay, and you're running interest charges, you're not what's known as a net payer, paying your balance in full every month, there's a direct benefit to you paying ahead of due date. Because remember, that interest is calculated daily, and you are saving a daily amount of interest paying it early. That's why I'm all about, if you're running a balance, paying your credit card early and often.
But if Peyton's language is correct, and it says if I pay off my credit card a few days further, if you're paying it off completely, you don't even have to worry. Libby in Texas says, do all phone company providers have to provide the Lifeline benefit for those who qualify or are moving service from one provider to another? Since Lifeline is a federal program, I thought they did, but Consumer Cellular says they do not. I will switch to them regardless due to your review, but I really needed the discount. Thanks so much for helping so many people.
So the Lifeline program is something that is voluntary for phone companies, and if they don't want to be a participant, they don't have to be. That business is very heavily dominated by a few small players, not small players, but a small number of companies dominate offering Lifeline service plans. And I will tell you, Consumer Cellular, year after year after year, is almost always number one on anybody's list in terms of customer service. They are not the cheapest provider of all.
The biggest ones that offer it are T-Mobile and Verizon, but then there's lots of, you can find a list. There's lots of smaller companies
that do offer the Lifeline rates. But and the FCC.gov, you can see a list of Lifeline plans, and you can see what they charge, if any. I mean, sometimes I think they're free for calling and texting.
You can get a free phone from some of these companies too.
Yeah, isn't that something?
Yeah.
Yeah. Well, they're free to you. They're being subsidized by your fellow taxpayers when you have one of these deals, Lifeline deals. If you qualify income-wise, disability, there are certain circumstances you can qualify for one. Coming up ahead, it has become so common now that people have a side gig, or their life is a bunch of gig work stuff. And with it comes a hassle that mere mortals just working for someone getting a W-2 don't face. We're going to talk about the tax traps you may have to deal with. It's so common now, even if you have a regular full-time job, that you're doing something on the side. It's also very possible that someone is doing just a series of side jobs. And I ride a lot in Ubers and Lyfts, and I talk to the drivers. My wife says I talk to everybody. She said I can talk to the wall. Anyway, so I'm always asking, what do they do? And I'll talk to these drivers. Overwhelmingly, they're working another job, or they're working other gigs, and they're doing the driving as well. So there are so many of us doing what's called in the tax law 1099 work, where you're not an employee, you are a worker. And when you are a worker and not an employee, you are basically looked at under the tax code as self-employed. And if you're new to it, you got to know that you pay more tax as a self-employed individual than you would if you were working for somebody else getting W-2 income. So you have to pay double Social Security tax, what's called SE tax, and so you're paying a big tax bill plus whatever income tax you owe, federal level, state level. If you have a state level, rare cases may have city income tax. And so a lot of people don't do anything about whatever taxes they owe till they get around to doing their tax return in 25 for this year. And it had been something that was very common that people wouldn't deal with it till later because the interest rates the IRS charged for a long, long time, because interest rates in the economy were so low, the interest rates were so low that people were like, okay, I'll just deal with it next year. Those interest rates are not low anymore, just as we're paying higher interest rates on car loans, mortgages, credit cards, whatever. The interest rate the IRS charges goes up with prevailing interest rates or goes down with prevailing interest rates. So right now, it's really, really high tax if you don't deal with it till next year. So here we are in August, and let's say you have not dealt with it all this year. Better late than never. There are what are called SE payments that are divided out 4 times each year. And the next one is due mid-September. And then, believe it or not, there's one for this year in January 15th. And in a normal year, this is salt in the wounds. If you owe tax from a prior year, you have to pay it by April 15th, right? And April 15th is also the first date normally that you would pay estimates for the current year. And I will tell you, most people that have side work, self-employed, never make that April 15th payment. They may make the one in June, but at the very least, remember, interest is accruing for taxes you've not paid in on self-employed work. You can pay them in, but there's something else you can do. If you are doing gig work, side work, whatever you're being paid 1099 for, you are eligible to do something known as a SEP. A SEP is a form of an IRA that reduces the income you have that's subject to tax from doing side work. The SEP is really simple to set up. The paperwork takes about a minute to fill out. You do it with one of my favorite children, one of the low-cost companies like Schwab, Vanguard, Fidelity. You set up a SEP, and you don't have to fund it till next year for this year, but it reduces your tax burden, which is so ugly, on side work and self-employment income. But I wanted to tell you now in August about getting money together to make the September 15th estimate, at least, to cover some of the tax burden that's building, that's accumulating interest. So, yeah, it would have been better if you made the 2 prior payments, but at least make one in September, and then don't wait till April 15th of next year. Make another estimate in January on your self-employed work.
So I think,
Christa, am I like somebody sending somebody to the dentist and working on them without Novocaine talking about taxes?
oh, well, that's the worst. But even worse, you owe a bunch of money and didn't realize you did.
Yeah.
And I think you may have answered a lot of Dale and Indiana's question, but I'm going to read it here. My wife recently became a 1099 employee, in quotes, after being a W-4 employee for decades. Is there a guide on what to track, tax tips, bookkeeping software, quarterly estimated tax payments, etc., that I should read or learn. I need to learn it quickly, and my wife is bad with math and receipts. Any help is appreciated.
So Dale, all right, here's what you say to your wife about the receipts, because every expense that she has against her self-employed income, because when a company treats you as 1099, you're not, you may feel like you're an employee. They may even have a cake for you on your birthday and stuff like that. You're not an employee, and you serve at their will, and they can get rid of you at any time without even having to worry about, the processes they would go through with an employee. And she's got this tax burden. And so every dollar of expense that she's incurred doing this self-employed work reduces the tax she's going to owe. It's found money. So you treat all those as if money fell out of the sky for every expense that she has. And so having like a simple zipper envelope that she carries in her purse that she puts receipts in right away will be a big, big help at tax time.
You can also download one of the free receipt tracker apps on her phone if she likes to do it electronically and take pictures of the receipts and upload them into a folder on her phone, so she already has them electronically.
Is that so funny? Analog, digital. Yeah,
I don't like paper, but I know you have to keep the receipts anyway. You do need to keep the paper.
But if you you don't have to keep the paper if you made a digital copy.
Okay.
The IRS accepts those now. They used to say they did but didn't. Now they say they do, and they do.
Okay.
As far as keeping track, there are very, very simple tools for people that are self-employed that are apps that she can use to keep track of things. I don't know a specific app I'd recommend right now.
I would also recommend paying a CPA for 1 hour of their time to go through what can you actually write off and what can't you, and like what to do with that, just to be sure.
Or it could be if you don't want to spend the money for a CPA who does tax, you could go to an enrolled agent, which is an expert at tax, but charges a much lower hourly rate than you're going to have with a CPA who does tax. But paying the estimates, really, really important. It's so weird I just explained that, so take that to heart.
Chris in Washington says we have 17 years left on our current mortgage with a rate of 3.25 and $275,000 in equity. We anticipate a work-related move by the end of the year and are considering renting out our current home and using equity to put a sizable down payment on a home in the community we move to. Our thinking is based on the great rate we currently have and there being a fairly small difference between the rate of an equity loan and a traditional mortgage. We also like the idea of investing in real estate as one part of our retirement strategy. Does this plan seem sound to you, and what other factors do we need to consider as we decide?
So, Chris, the thing that about this, a lot of people are making a very wise, rational decision like you are. Cost of money today, 6.75% or so for a mortgage. You're at less than half that. It's like found money every month that increases the profitability of you having this as a rental property. You will erode some of that benefit with the home equity line of credit. There will be a floating rate, by the way, on the interest, but it gives you an opportunity to build continual wealth by having this rental property. Then there's the practical issue. You don't say where you're moving to from Washington State. Who's going to handle maintenance and repairs? Who's going to handle if there's a problem with the tenant paying rent? Who's going to handle that for you? You may find if you're moving far away across the country or whatever, you may need to hire a rental property manager to manage the property for you, which will reduce some of the net profit you'll make every month from the property. You need to think through how you're going to handle actively managing that property from another place that could be far away. As long as you figure that out, I think it's very sound for you to maintain that property as a rental.
Nancy in North Carolina says our primary car died suddenly last August, which left us without reliable transportation. Our other car, a Mini, is 18 years old. We purchased a 2022 Camry with 7,500 miles. My credit score is 823, and I have no debt except this $20,000 loan, which is nearly 8% at $607 a month, with 36 months remaining. Researching refinancing does not seem to help. Clark has mentioned that new cars may now be overstocked and a bargain. These are the options that she wants you to consider. 1, sell the Camry and buy a new car with a lower interest rate. The prior car was 8 years old. 2, pay off the loan completely. 3, stay the course until I'm ready to pay off the current loan. I'm looking at joining a credit union for backup when financing is needed in the future.
Right. So first of all, with a car that's 8 years old, that you found one with only 7,500 miles on it is miraculous. That's incredible. And the Camry has such a good track record, it should last a really long time. I hate the 8% interest rate, obviously. $600 a month is a big payment. Here's the problem. The value of used vehicles has fallen 27% from its peak. It may be more like 30% at this point. And so this vehicle may not have a value close to what you paid for the Camry when you bought it used. Maybe it does, maybe it doesn't. That would be what you'd want to check. You can check with CarMax, you can check with Carvana, and see without even involving buying a new vehicle and trading one in. First, get a marker, get a feel in the marketplace what the fair market value of that Camry is. Then that gives you the information you need that if the value is substantially less than the remaining balance, then you're stuck in it for now. If the value is equivalent, then you can go shop the market. What would it cost for a new vehicle right now? Does it make sense for you to take on the additional debt between the value of what you have now and the loan you have now and what a loan would be on a new vehicle? So the answer first will emerge from getting a value from CarMax and Carvana. From that point, you'll know whether it's a smart thing to proceed or just drive that very low mileage Camry for a long, long time. And I want to thank you so much for joining us on today's podcast. And know that we are here to serve you around the clock at Clark.com and at ClarkDeals.com. Because what I'm about is empowerment, that you grab hold of the knowledge that gives you the power to act on and make better financial decisions in your life so you can save more and spend less and avoid getting ripped off. And we'll be with you tomorrow.